Hi everyone, I just wanted to give you a really short presentation today about capital raising readiness. Raising capital, whatever form that might look like, it's important to be prepared. And so obviously there's different factors you need to look at in being prepared. And the pitch or your presentation to whoever the funding source might be is a really important part of that. And so being very clear about what that pitch is and what your ask is, and then what problem are you addressing, I should say. And then there's a solution that's going to address that problem. The team, who within your team can provide that solution? Do you have the capabilities in-house to be able to do that? Or do you have external parties? But being very clear about what that map looks like, to be clear in your pitch to the funding source. And then what traction do you have so far? Do you have any traction today? What does that look like? If not, then what does the traction look like in the future? And how are you going to get that traction? These parts of the pitch are important. And there's other parts of the pitch I'll go through later in this presentation. The capitalisation table, cap table, you're the founders of the business or founder of the business. What equity do you have? And then if you're bringing in equity funding, for example, and I'll go through the different types of funding later, is there any dilution that's required and what does that dilution look like? And then the target raise, how much are you looking to raise? And that's a really important part in sort of the capitalisation table and what that capitalisation table looks like at the beginning and then in your funding round that you're looking to do today. Hit lists are really important. Who are you looking to target for the funding? They have an investment thesis. Understand what that investment thesis is. Investment thesis means, do they invest in your sector or are they agnostic, invest in various sectors? Do they invest in the stage of your business is at the moment? And I'll go through what those stages look like in a minute. And then do they lead the investment? Not all funding sources lead an investment. There might be other parties that back off the lead. So understanding your hit list, whether they lead or piggyback off a lead, when you put together your hit list is important. And then the funds that they have deployable doesn't match what your target raise is and the timing around that. Talking about timing, capital raising process takes time. So it's really important to understanding what this timing is and what factors are included in the timing. So the presentation or the pitch that you need to do, how many pitches are you going to need to do to get to, are you starting with someone more junior in the organisation and then before you get to someone more senior? And then the emails and the meetings that you need to do to sort of get to a decision point and what that process looks like, the timing around that process. Due diligence itself, due diligence can take time. So understanding the party that you're talking to, what they're or on the hit list, what their due diligence, the timing around their due diligence is. So you get a sort of a full scope of what the timing is. And then the negotiations around the terms and any legal agreements or documents that you might need to enter into. So understanding that whole timing process is very important in preparing for capital raising. Other points about preparing for capital raising is really the financials and what your forecasts look like. How much capital is required, as I mentioned, and what does that might look like. So preparing your financials and your forecasts is an important part of that. Business structure is another really important part. Some business structures are quite complicated, and the more complicated they are, the harder it is to explain to an investor. So try and clean up your business structure before going out to raise capital if you can, or being very clear about why it's complex. And sometimes that can be a barrier when you're presenting to investors or funding providers. Preparing your sort of investor presentation or your pitch deck, as I mentioned, practicing the pitch deck, refining the pitch deck. But then also you'll probably have an IM or information memorandum, which sits behind that for the next stage of the potential funding source or investor looking at your business. The IM will include sort of much of what you have in a business plan, but also then your capitalisation plan and what your capitalisation table, your cap table, what does that look like? If you're getting equity, then how does dilution affect and what the investor gets in equity and so forth. So your information memorandum will not just be a business plan, but includes your capitalisation plan. And that's part of that document. And an IM can be a short form or long form document, meaning a shortened version of the IM that you might initially use and then a much more detailed version. Some people use a short form IM and some people use a long form IM, or some people have both. And then sort of practicing your pitch, as I mentioned, and sort of the negotiations, having your term sheet prepared, and then any legal documents. If it's a debt provider, they probably will have their own documents that, when you get to that point, that they'll present to you. But if you're looking for equity, then you might have your own term sheet prepared. Or if you're looking for convertible notes or a safe note, then you might have those drafted and ready in readiness for going out to capital providers. Understanding your stage of capital raising is really important. As I mentioned, your hit list. understand the stage of where they are. You might be in the seed capital stage. Make sure that your hit list is in that seed capital stage, not at the later stage, for example. So understanding where you sit in the stages of fundraising is an important part. Different types of funding sources. Sweat equity is you as the first investor, as the founder of the business, is obviously sweat equity. But sometimes you might be able to get a strategic party that provides strategic expertise, knowledge, connections, and you might give away some equity, for example, for someone like that. Rather than them investing capital into the business, you might give away sweat equity for a strategic party. Debt funding. There's various types of debt funding that you might look at. Subsidies or grant funding. Often grant funding from government sources, for example, are non-dilutionary. So it's just understanding what's out there, where they fit. So not all grant funding is suitable. Equity funding, as I mentioned, you're giving away some of the equity for some capital. And then revenue. All businesses can use revenue to grow business. It can be used as a funding source as well. So some of the pros and cons of some of these funding types. I won't go through all of them, but everyone knows the sort of the 3 Fs in here. It just mentions family and friends, but you also got what they call fools. But that's usually a trust-based mechanism to get funding into your business. But you've got to also be careful. You could lose friends if the business doesn't work out, for example. Grants, as I mentioned, or subsidies, quite often is limited due diligence. It's quite a transparent process. But is it the right fit, as I mentioned before? Is it the right fit as in the grant funding only invests in certain types of sectors or different stages of business? And do you have to have match funding? Quite often, government grants or subsidies require match funding. So, understanding that's very important. Equity crowdfunding, very popular. Although you can raise money reasonably quickly, there's a lot of work to prepare yourself to get to that stage. And when you go to the equity crowdfunding, you're opening the business to the public or for those parties to look into the business. So be prepared for that. Angel investors, very early stage. One of the good things about angel investors, quite often they'll provide hands-on support. They'll provide advice or mentoring. And sometimes, depending on the stage of the business, that can be really important. But if your business is taking a long time to grow or get traction, they can run out of steam. So it's important to understand that. Venture capital, more later stage, understanding the amount of funding that they have. And they quite often, venture fundings have the scope for capital, and they can also do subsequent rounds in the future. So understanding that. But quite often, you could potentially lose control. So if they're taking a large stake in the business, for example, you might need to give a board seat or a director role to someone, and you might lose some of that control. So it's important to understand the pros and cons of the different funding sources. Some examples of funding sources. We have funds available here in Western Australia from some of the venture capital groups like Purpose Ventures, Fund WA, etc. In the Indigenous space, you have Indigenous focused funds like Indigenous Business Australia, First Australians Capital, but there's also angel investment groups, Perth Angels, Southwest Angels, etc. So what is value? Value is really the estimate, the value of an asset based on a knowledgeable party that's willing and unpressured to buy or pay, I should say, a knowledgeable and willing unpressured seller in the market. So it's really both sides of the party agree to what that value might look like. But there's different valuation methods to sort of get to you a starting point. There's cost-based method, which I'll go into in the next slide. There's multiples of revenue, discounted cash flow, peer-based or comparable company methods. There's various methods that you use to value your business, and it's important to understand those. But the most common ones are really cost comparable or peer-based, and discounted cash flow models. I like to use personally the cost base, which is really the cost to build or replace the business as your sort of your bottom line. The other two methods, comparable, peer-based, discounted cash flow models, I like to do both of those for a business, for example, and then quite often then get the average of both of those. And they're both different methods and both commonly used. Discounted cash flow model seems to be used quite regularly, but I like to show that there's rigor in the valuation by doing two models. Maybe you provide both of those valuations, or you provide the average of both of those valuations. But it's important to have a method, and I often like to do both to show, like I said, more rigor around what your valuation looks like. So what is a discounted cash flow model all about? As I mentioned, it's a valuation method or technique that uses what the expected future cash flow in conjunction with the discounted rate to estimate the present future value of an investment. So this is a commonly used valuation method, but I like to use this together with the comparable or peer valuation as well. So what do investors look for? Your team is really important. They need to understand that you have the capabilities, whether that's internal and external, but they need to understand what that team looks like and that you can provide the solution to a problem. Proof of demand. Is there demand in the market? Do you already have customers? Or do you have customers that have expressed an interest? Any proof of demand of what you're providing is extremely important. Market size and potential. So what does your market size look like today, and what the blue sky or what the future market size look like? Do you understand what it is? Do you have any rigor around why it's this big today and why it's going to be that big tomorrow? Investors need to understand those metrics and those assumptions that you've used to sort of paint the picture of what the market potential is for today and the future. Competitors, very important. Understanding who those competitors are and why you might be different. And as I mentioned, do you have committed customers today? Do you have cash flow? If you do, fantastic, but spell that out very, very clearly. And then potential for step change or growth. What does that growth look like? And how are you going to get to those growth stages? Do you have global aspirations? A lot of VCs are looking for very big blue sky. You might not be looking for VCs. You might not be at that stage, but just understanding that. And then really important, what does your exit strategy look like? Is that a trade sale, M&A, or IPO? What does that look like? All investors are looking for a return of some sort. So what does that look like going forward? And there's, understanding the risk and reward. So there are a number of things you need to be prepared for. And this is just a really short snapshot of what they are. And I hope that this presentation has been able to give you some insight on what you need to do, some of the things you need to do to be prepared. Thank you.